Ajay Bagga too joins in on the show. Ajay, hi, afternoon. Good to have you on the show. I guess all eyes on Sunday, of course, the World Cup final. But let's talk markets before that. We'll chat about that in just a bit. Ajay, what do you do with the private banking names and NBFCs like Bajaj Finance in lieu of the RBI norms now? Do you think this dip is to be bought into, or would you want to wait it out?
I think we can wait out for some time to see, let the impact work through. I am hoping that the impact will be overdone, so it will give a buying opportunity. Very well-run companies and with very strong business models. RBI has increased the risk-weighted asset percentage to kind of mellow down the growth of unsecured lending. So that impacts the business models or the business growth to some extent. We will have a better idea over the weekend once the sell side brokers have met the managements and bring out their projections. Today has been an overreaction, but we can wait out, Aisha. No rush in this kind of a market scenario. We'll wait it for a couple of weeks, let it work through, and you will get an entry opportunity.
Sure, point taken. So that's a take as far as some of these lending norms and implications are concerned. But I want to take a step back, Mr. Bagga. You follow the global economics also very closely. The kind of data that we have got from CPI as well as PPI globally, that's got people to believe that next year, perhaps at the start of the year itself, we might be talking about rate cuts and there won't be a rate hike in December as was earlier anticipated. Your own reading of the numbers?
Absolutely. I think no more rate hikes by the Fed. The ECB also has said that they would be on pause. I don't think you will get rate cuts before June. And the biggest issue there is, or rather the tailwind there is that the economies are growing much more than forecast, especially the US economy. So the last quarter projections for the US economy are at about 2.1, 2.2% growth year on year. Much higher than what was anticipated this time last year. The good news is 0 to 5% is done. You're not going much further, even in a worst case scenario, maybe one rate hike more by March in case the oil prices shoot up or the Middle East war expands out. Only then you could see the Fed or the ECB's hands forced. Otherwise, we are very much at the peak of the rates, which is good news. Higher for longer, they are insisting. I think that will last for another 2 quarters. So around June is when we are expecting the first rate cuts from the Fed and maybe 4 to 5 rate cuts going into December of next year. That is what we are expecting. The Fed's target of 2% will not be met till about 2025, unless there's a very strong economic contraction. That is not the consensus right now. Consensus is for a softish economy, not near any contraction or recession kind of numbers, but softening global economy and fragmentation with Europe slowing, Japan slow, China trying to ratchet up but slower than this year, and US continuing to grow well. India providing a good boost to the global growth with a 6% plus print in terms of real GDP.
Sure. So what does this do to our own market? Are you expecting those LIFI levels to be hit soon, given all of these headwinds which are there at the macro level seem to be now abating?
I think that we'll get this market to top out by February or February end as soon as the last budget is done with and elections are announced. We'll probably peak nearer to that. Then 2-3 months of volatility as the new government gets formed, and during that time investors will be skittish and new money will wait out those 2-3 months. And then come June, we should resume. So that's a linear view. Of course, markets will be much more lumpy, much more cyclical than that. But I think seasonality is working for us. Good macros are working for us. And probably next 3 months, these markets will try to make up for what they have missed out over the last 2 years and give us pretty good returns and then become flattish to sideways to maybe mildly downtrending till the election results come in and the new government gets formed and then resume their journey upwards.
Right, okay. Stay with us, Ajay. Lots more to talk about, but I'm going to quickly take it across to Sharad as well and get in a check on what the dealing room chatter is right now.
Well, yes, in focus we are having SRIRAM Properties, and what we are hearing from the dealers is that a block deal is expected to happen for the stock. Now, a large PE player is set to be offloading this stake, and importantly, for the last 2 to 3 odd trading sessions, the volumes have also picked up for the stock. Recently, the Q2 numbers also came and they were very strong, and we did look at the realizations also. And in the first half, the realizations also spiked up by almost 14% on a year-on-year basis. Going ahead, the guidance, two important things to watch out for the stock. The first one is it is on track to hand over roughly 3,000 odd units for FY24. And when it comes to the launches, they're expecting almost 3 to 5 launches in the second half of fiscal year. Lastly, they have also stated that the targeted completion would be there of 5 key projects in this H2 FY24 as well. Apart from this, the institutional interest is also being seen in the stock as well.
Right, okay, that's the talk coming in right now in SRIRAM Properties. And Ajay, that's been the one buoyant space, right? Real estate as well as the entire home building theme. And, you know, just about everyone is now trying to figure out where are the new opportunities or ideas within that pack. The one space which has also done very well in lieu of all the construction, infrastructure, development as well, has been wiring and cable. Wondering whether there are opportunities to add positions here, Ajay, or anything that you like within this theme.
Overall, how we have to see in a macro way, we are probably in the 2.5 to third year of the real estate recovery cycle and the boom cycle. So this goes on normally 7 to 10 years is a real estate cycle. They are pretty long cycles, unlike the stock market cycle. And what we are seeing is growing ability of people to fund their housing loans. The housing companies are able to give long-term loans which reduce the EMIs and increase the affordability, and the market pricing having been correct. What has happened now is that most of the inventory has got wiped out. So a lot more of construction will need to come in, and supply will probably be ahead of demand, which is good news for the listed real estate players. We expect them to continue to do better. The building material players are again on a good cycle. They are riding off this real estate boom. The construction and infrastructure companies, with the 10 lakh odd crores of central government funding, state government funding, and private capex still very nascent. That will come through, on an 11 lakh crore profit pool of private sector companies. We used to see 7 lakh odd crores going back into capex or renewal of their assets. That has come down to 4 lakhs. I think post the elections and once the new government finds its bearings, you could see some of the sectors starting to invest in private capex, and that will add a lot of traction. So industrials, construction, real estate, building materials, all looking good. Cement should do well. Again, cement, the overhang always remains of new capacity additions and how does the demand catch up to supply. But we are seeing a lot of demand coming through. And again, 6 months down the line, we expect a lot more announcements, and that should keep the cement players also bid up. So cement also looking good on a 1 year basis.
Mr. Bagga, what's your sense on the pharma sector, and is there any specific name that looks positively placed?
Name I won't be able to give, but pharma sector, there are a lot of attractive opportunities now coming through. Firstly, the US generics market, the revenue fall has plateaued off, and we are seeing some amount of gains now coming in year on year. So opportunities are there. And then quite a few of the Indian owned pharma companies that we like. Hospitals have done very well. I think those should continue to do well. Lot of opportunities there for further growth, for greenfield projects to come in. So pharma in this kind of a scenario that we are envisaging over the next 1 year should do well. It remains a defensive sector overall, but given that it has been an underperformer, under-owned sector for a number of years, we see that short time turnaround coming through to pharma, and some selective pharma are looking quite interesting and should do well. Hospitals as a sector is looking quite interesting and should continue to do well.
Ajay, great to have you on the show. We'll let you go on that note. Thanks as always for taking the time out and speaking with us today.